Hey yo, welcome back, IB Macroeconomics students. We have finally did it. We have finally finished our syllabus concerning macroeconomics. Now, what does that mean? That means we're going over every single topic, every single content you need to know for the course. In this video, this is a very long video, okay? I apologize for that in advance, but I am very, very excited for macroeconomics review lecture, okay? Man, this is the complete lecture, okay? So, I have listed out every single thing we have to know concerning macroeconomics in this video, okay? And I have listed out everything, the subtopic as well as the points you need to understand for HL and SL. So let me just jump into it. The first topic you have to know, the first chapter, is the level of overall economic activity. Now, the first thing we learn in macroeconomics is the circular flow of income model. Is the idea that your income will become spending, and your spending becomes somebody else's income. Now, that and in the circular flow income model, which I have also made a video. For each of these topics, I have made a video, so you could go back and refer to it. So the circular flow of income model, we have the government, we have the financial sector, which is the banking sector, we have the private sector, the public sector, and we also have the international sector, which is imports and exports. And using the circular flow of income model, we can actually see how money flows around the economy, for example, the labor force, the labor force provides firms with labor, when firms provides the labor force with money and goods, and the government takes both of them with taxes, and the governments regulate them, but also provide them with government spending, right? So this is the circular flow of income model. You have to be able to identify and talk about the factors of production in respect to payment wages, and you also have to be able to know the different factors in the economy and how they interact with each other, and how money plays a role in actually interacting with each other. And the next idea we have to be able to talk about is the measures of economic activity. How do we actually measure the economy? Whether it is GDP, gross domestic product, GNP, gross national product, or GNI, gross national income. You have to be able to distinguish between the three. So GDP, gross domestic product, actually has two types. There is the nominal GDP and the real GDP. The nominal GDP is not adjusted to inflation, okay? However, the real GDP uses the GDP deflator, which you also have to be able to calculate, uses the GDP deflator and gives the real figures, actually the real gross domestic product instead of nominal GDP, which is accounted for inflation. Gross national product and gross national income. So gross national income accounts for the companies in other countries. For example, McDonald's is an American company. However, McDonald's companies in China, the income of McDonald's companies in China is not accounted for in the GDP of America, but it is accounted for in the gross national income of America, since McDonald's is an American company. So I hope this is helpful in some ways. If you have questions about this, I have made many videos. I have made quite a couple on gross domestic product, gross national product, and gross national income. If you have questions about these, please go back and refer to it. Now, on the right-hand side of all of these columns, I have written down all of the things you have to be able to know. Look at it. If there's any questions, you have to go back to look at the videos. Short-term fluctuations and long-term trends. Now, in this section, you have to be able to talk about the business cycle, right? The boom and bust cycle, where we have increasing and decreasing in the short run of real GDP in correlation to the long-term growth. So we have to be able to talk about this. We have also made a video on this in the past. So you also have to be able to talk about the causes. Okay, why does the boom and bust cycle? Why does the business cycle occur? The aggregate demand and aggregate supply is topic 2.2 is a very important and actually quite a difficult topic. So first of all, the AD curve. Okay, what is the aggregate demand curve, and why does it slope downwards? Okay. And the reason that the AD curve slopes downwards is actually different from why the microeconomics demand curve shifts downwards. The AD curve shifts downwards because of the wealth effect. Okay, when prices are lower, consumers get to buy more stuff because the money is worth a lot more. So when prices are lower, consumers get to buy more stuff, and when consumers buy more stuff, our GDP increases. So that's basically why AD curve shifts downwards in the macroeconomic sense. However, in the microeconomic sense, it's different. So the distinguishing factor is just this. Components of AD, once again, we have consumer spending, C. We have government spending, G. We have investment, Y. we have invested I. We also have exports minus imports. Those are the components of aggregate demand, which is also not so coincidentally the formula for for gross domestic product. Anyways, the determinants of AD and causes for a shift in the curve. Many things. Why could aggregate demand shift? Is it because of monetary policies? Is it because of fiscal policies? Why does the aggregate demand curve shift to the left and the right? Contractionary monetary policies cause AD curve to shift to the right. Contractionary monetary policies such as tax increases, such as increasing the interest rates, such as reduction in government spending, increases in AD curve could be caused by expansionary fiscal policies and expansionary monetary policies, such as reducing interest rates, such as increasing government spending, such as reducing taxes. So you have to be able to talk about why the AD curve shifts and the causes for the shift, basically. The meaning of aggregate supply, you have to be able to talk about aggregate supply. Why does it shift upwards in the short run? What does aggregate supply look like in the long run? Okay. Aggregate supply has a lot of different ways to draw. You could draw a sloping line with an upwards sloping curve. You could also draw a completely vertical line. You could draw even a kinked line, like the Keynesian view, right? It is horizontal first and then it goes vertical. So there are many ways you could draw the aggregate supply curve. Now you have to just be able to explain why it shifts upwards like that and the difference between the short run and the long run. Now, alternative views on aggregate supply. Once again, we have the long-run aggregate supply. We have the Keynesian aggregate supply. Within the Keynesian aggregate supply, every single point on the LRAS curve of the Keynesian view can indeed be the long run. So, alternative views on aggregate supply is another thing you have to be able to talk about. Shifts in the aggregate supply curve, whether it is once again, taxes, whether it is increases or decreases in interest rates, these all affect the aggregate supply and they're all affected by shifting it. Short-run equilibrium. Now, what is short-run equilibrium? With reference to the neoclassical SRAS curve, short-run aggregate supply curve, the curve, okay, well, the short-run aggregate supply shifts upwards, okay? That basically means that short-run aggregate supply shifts upwards in the neoclassical. However, in the Keynesian model, aggregate supply in the long run is going to be a vertical line. So short-run equilibrium is differentiating from long-run equilibrium because long-run equilibrium accounts for employment at the fullest extent. So that's the difference. You also have to be able to talk about the differences between the two. Equilibrium in the neoclassical model. Once again, that's we have talked about that. It could be equilibrium in the neoclassical model. Could be either in the short run or the long run. Okay, the short run is when the aggregate supply curve is sloping. Okay. However, in the long run, the aggregate supply curve becomes a vertical line because the factors of production are at its maximal level, and then you could shift the curve to the right. However, you cannot move up and down move horizontally on the curve. Very good. Muy bien. Next, we have the equilibrium in the Keynesian model. Once again, the Keynesian model, every point along the aggregate supply curve could be in the long run, which means that when economy is in recession, it could be in recession in the long term. And factors of production and the market may not be able to correct itself from being in a recession. That's basically the Keynesian view. There's, of course, a lot of debate and interpretation and difference in viewpoints on what aggregate supply curve actually looks like. For IB economics students, as long as you're able to explain either Keynesian or classical and explain it very well, that's right. Nobody cares if you use Keynesian or classical. The nature of the Keynesian multiplier effect, you have to be able to know the multiplier effect, right? What is the marginal propensity to consume? What is the marginal propensity to save? We have all talked about these topics in previous videos. If you have any questions, please go back and look at it. We also have a playlist. Now, the Keynesian multiplier effect is basically the idea that you're spending, okay, a person's spending because another person's income. And when another person receives his income, then he gets to spend again. And therefore, because of the circular flow of the model, without any leakages, theoretically, any spending in the economy is infinite spending in the economy. So that's why government spending, okay, for example, if a government spends $1 billion on infrastructure projects, does that mean the government only injects $1 billion of liquidity into the economy? No, that's not what happens. When the government spends $1 billion, the workers receive the money, the workers save some money, but the workers also spend the money. So when the government spends $1 billion of money, liquidity injection of $1 billion occur. However, the real GDP increases maybe it will belong a billion, maybe 3 billion or 10 billion, okay, depending on the marginal propensity to save and the marginal propensity to consume. Okay, Unit 2.3 is what we call the macroeconomics objectives. What are the objectives of a of a government and a central bank in the macroeconomics sense? Well, one thing is to reduce unemployment, to increase economic growth, and to reduce the inflation rate. Now, meaning of unemployment, well, it's quite easy. We have to be able to see unemployment is the state at which a worker is not working, however, he is seeking work, and however, unable to find work. So that's the meaning of unemployment. Consequences of unemployment, for example, debt weight loss of government revenue, loss in tax revenue, loss in unemployment benefits, are also the social consequences of it, whether it will be increased crime. But on a realer sense, YFE cannot be achieved. Full unemployment cannot be achieved. And when full unemployment cannot be achieved, inefficiencies in the market occur because the distribution of resources is not at the optimal level. Now, furthermore, types and causes of unemployment. There's 3 types of unemployment. There's structural, frictional, and cyclical unemployment. Now, structural unemployment is when there are problems in the structure of the economy, and perhaps workers are laid off because their skill sets and their abilities do not match up with what is required for their field. For example, in Taiwan a few years ago, on the highways, right? They have these toll booths. Every 5 kilometers or so, you have to pay a fee. But however, automation and technology comes their way, and now those toll booths that used to have real workers in there collecting the money now becomes an electronic payment, right? You drive by, the sensor license plate, and they retract or they subtract a few dollars from your account, right? So that's different. Nowadays, that's what we call structural unemployment, where technology, globalization, or other factors replace employers because their skill sets are no longer matched with what is needed. Now, the second type of unemployment is what we call frictional unemployment. Frictional unemployment is what occurs between jobs. For example, a college graduate just graduated university, and a phase between his graduation and finding job, that phrase, okay, that time period between graduating and finding job is what we call frictional unemployment. Other forms of frictional unemployment could be you have just been fired from a job, or you have just left the job and you're currently seeking another job. That's also what we refer to as frictional unemployment. Now, the last type of unemployment, our cyclical unemployment, is the bad type of unemployment. Nobody wants cyclical unemployment. Cyclical unemployment is when aggregate demand is so low that firms cannot justify having more workers, and therefore they have to fire workers. Now, that's very bad for the workers. That's also very bad for the economy as a whole. Okay. The meaning of inflation, disinflation, and deflation. So inflation is basically when prices of goods decrease, when prices of goods increase because of a variety of factors. So when prices of goods increase and the purchasing power of money decreases, that's what we call inflation. Disinflation is when the rate of inflation decreases. For example, last year, we may have an inflation rate of 4%. And if this year we have an inflation rate of 2%, then that's what we call disinflation, because the inflation rate decreases. Now, deflation is different from disinflation. Deflation is when we have negative inflation. It's when the purchasing power of money increases over time. Now once again, deflation and disinflation and inflation can all either be good or bad. Now, depending on the viewpoint and depending on the factors that you are considering. Okay, so consequences of inflation. When inflation occurs, once again, consumers get to buy less stuff because of the prices increasing. Now, inflation is also caused by a variety of factors, and it could either be good or bad. Possible consequences of high inflation, greater uncertainty, a redistribution effect, and such a case. Types and causes of inflation. Now, there are a few types of causes of inflation. There are, once again, changes by increasing money supply. Okay? For example, when the government increases money supply, when the central bank increases money supply increases, inflation occurs. That's one type of inflation. Another type of inflation is when the factors of production, such as wages, such as resources, such as oil prices, decreases. Therefore, the factors of production causes the production cost to decrease. When the production cost decreases, firms get to charge consumers less money for it, and therefore deflation occurs. Or inflation occurs if the factors for production has increased in price. So possible relationships between unemployment and inflation. This is a very good topic for your IAs. I have also seen students written on the Phillips curve for the IAs. Talk about the relationship between interest rates and inflation. When interest rates increases, potential inflation would decrease. Potential inflation would increase. Okay, when interest rates increase, money supply will increase in the economy, and inflation. And unemployment will decrease. When interest rates are lowered, money supply increases, and unemployment decreases. So this is also really well illustrated in the Phillips curve. You can just go on Google, search the Phillips curve, and you can see the relationship between unemployment and inflation. The meaning of economic growth is, when real GDP gets shifted to the right, or when real GDP or GDP or any other indicators of the economy increases. Causes of economic growth, once again, we have a lot of different factors, but economic growth comes when LRAS, long run aggregate supply, gets shifted to the right. That's basically when we with reference to the production possibility frontier, where the production possibility frontier curve gets shifted to the outside. Okay, that's economic growth, and causes could have a lot of different forms, like increasing the size of firms, more employment, or even more profitable firms. These are all causes of economic growth. The meaning of equality and distribution of income, once again, we have talked about for indicators of income inequality and poverty, the role of taxation in promoting equality. These are all really minor topics that you only just have to read your textbook and be able to understand. But the role of taxation in promoting equality could be seen as we have talked about in our course. We have talked about progressive taxation, right? If you make between $1,000 and $20,000, then you get taxed at, for example, 5%. If you make between $20,000 and $50,000, then you get taxed at 10%. If you make between $30,000 and $50,000, then you get taxed at 40%. If you make between $80,000 and $1 million, then you get taxed at 50%. If you make above $1 million, then you get taxed at, let's say, God knows, 70%. So this is the role of progressive taxation. These are direct taxes because they address the person directly, instead of indirect taxes, such as taxes on alcohol or cigarettes. So that's the role of taxation in promoting equality and equity. Other measures of promoting equality and equity, subsidizes, government handouts, food stamps, taxation of the rich, such as that. Okay, let's talk about fiscal policies. What are fiscal policies? Fiscal policies are policies relating to aggregate demand enacted by the government. Well, what do I mean by that? The government has a few ways to influence the economy. The government could increase taxes, the government could decrease taxes, the government could increase government spending, or the government could decrease government spending. All of which will increase the money supply and increase the economy in many ways. So first of all, the sources of government revenue could come taxation, or the direct or indirect taxation. Direct taxation is when the government taxes individuals directly, such as income taxes, such as property taxes. Indirect taxes are when government taxes goods that people buy, such as tobacco, such as cigarettes, in America, or marijuana, God knows what, or alcohol products. So these are all sources of government revenue. Okay. Fiscal policies in the short run, the impact of automatic stabilizers, fiscal policies and its impact on potential output, evaluation of fiscal policies. So fiscal policies is basically this: government spending. Okay, you have to be able to talk about short run, long run government spending, the effects of contractionary and expansionary fiscal policies, and its effects on consumers. You also have to be able to talk about why the government will want to use expansionary fiscal policies at some time, and why the government will want to use contractionary fiscal policies at other times. Okay, so monetary policies is our next topic. Now, a lot of students, I mean, a lot of students, even the top students, confuse fiscal policies and monetary policies. Monetary policies are policies enacted by the central bank, where in the case of America, the Federal Reserve, to influence the money supply. In most cases, I would say 90% of the cases, the monetary policies includes something about interest rates, whether rising interest rates or decreasing interest rates, and it has always something to do with interest rates. Now, interest rates is not one figure, okay? When we hear the politician talking about increasing interest rates, that is not just one figure. We have interest rates in mortgages. We have interest rates in businesses. We have interest rates in this and that and this and that. So for example, right now in Europe we have a negative interest rates. But does that mean you get to the banks pay you money to borrow money to buy a house? No, because interest rates comes in different sectors. So there's the mortgage sector, there is the private sector, there's the public sector, and the individual sector. So differences in interest rates are also another major monetary policy. Supply side, demand side monetary policies. You have to be able to talk about why governments will like to use supply side monetary policies. Once again, to increase supply, to increase real GDP over time, and to actually push the YFE to the right over time in the long run. Now, investment human capital, investment infrastructure, investment technology, investment policies, labor market reform, things like that. So, there we go, man. That's the IB macroeconomics syllabus. Every single damn thing you need to know for this amazing course. So I really hope this video is helpful. In our next section, in our next syllabus, we're going to start talking about international economics, where it is actually a very, very interesting topic. When we're talking about trade, we're talking about comparative advantages. Man, I'm an economics nerd, but don't take it from me. Just look at my videos. I hope this video is helpful. I hope this series and this lecture is helpful. If it is, please drop a like and subscribe. And I hope to see you guys in the next unit, in the next